Good afternoon, everyone. This is our week 7, and we are going to talk about this. We're going to be discussing about Introduction to Capital Budgeting, which is chapter 8 and 9 of the book. And the topic we're going to cover, the questions you're going to be considering here today is what are the relevant cash flows in capital budgeting? What are conventional and non-conventional projects? What is meant by the payback period? What are the net present value NPV and internal rate of return methods? When and why do the net present value and internal rate of return methods give conflicting results when ranking mutually exclusive projects? So these are our 5 topics we're going to talk today. Okay, so let's start from the first one. Introduction and the calculation of relevant cash flows. Okay, all right. Now, what is actually our capital budgeting? What is a capital budget? That's the first thing we're going to talk about here. Okay, so what is capital budgeting? According to the definition we have in here, said capital budgeting refers to the process of developing and analyzing investment projects and deciding which ones should be included in the capital budget. So what they mean here? They say that it means here that capital budgeting refers to the process of developing and analyzing investment project. All right. So first, it's a process. What is this process about? Process of developing and analyzing investment project. And then deciding which one should be included in the capital budget. And deciding which one to go through, which one should be included. Okay. So a firm will have some money to invest it, and they will decide that how and where they are going to make this investment. Okay, so before they do this thing, the next line says it very clearly, they will have to think what will be the outcome. They will have to think what will be the outcome. Okay. The camera is actually not giving a blurry picture. And they will have to decide which one will be giving them a good cash flows. They will make these decisions in here. Okay. So now if we move on, okay. So there are 4 basics. Okay. So we'll say here there are 4 different types of capital investment we have. 4 different types of investment project we have. Okay. It's sort of like the way we have done with our share and bond valuation we did. Okay, which one gives us a better values? In this case, we'll be looking at which project will give us a better return. That's what we'll be thinking in this project. Okay. And also, there are, as I said here before, there are 4 different types of categories we have, 4 different types of project we have. What are these 4 different types? One of them is called project displaying a conventional cash flow. Project is a conventional cash flow pattern. Okay. Another one is a non-conventional cash flow pattern. So what you're trying to say here, we are saying that a capital budget A capital budget meaning that when we are making an investment, we are actually analyzing, okay? We are actually planning and analyzing, okay? But how much money we're gonna invest and how much return we're gonna get. This is our main theme in this case, okay? It's a plan on a fixed assets that how much we are going to invest and how much return we're going to get from there within how much time. That's what we are going to analyze mainly here. When we analyze these things, cash flow investment is an important thing. Cash flow is very important thing. How the cash is coming out, how the cash is going out, and how much cash is coming in to the business. In that case, we say one of the ways called conventional. The conventional cash flow pattern is one of them. One of them is called conventional cash flow pattern. Now the question comes up, what is this conventional cash flow pattern is? What is that? It means that have an initial net cash outflow, which means that at the beginning, you make an investment. 10,000, 100,000, 20,000, you make an investment. The money is going out of the business, cash out. Okay. So first one is the initial net cash outflow investment. Then with subsequent relevant cash flow all being net cash inflows. First you make an investment, then the slowly cash start to come into the business. So first is cash outflow, then the cash inflow start to come in. This is conventional method. Non-conventional method. Non-conventional method is this. Non-conventional cash flow pattern is characterized by one or more net cash outflows after initial net cash outflow. So first you make an investment. But later you make another investment out. Cash outflow will be there. So in our topic, we are not going to talk about non-conventional cash flow. We talk about conventional cash flow pattern we'll talk about. Okay. So let me draw a little bit here so you can understand it better in here. In this case, if I draw a little bit, it will be nicer. Okay. Draw a bit here.
Normal voltage. The Bluetooth device is ready to pair. The Bluetooth device.
All right. So here we are going to draw and show you this. Let's say this is a line. Okay. And in this line, we are going to show you here one, two, okay, 3, 4, 5, 6, 7, for example. Okay. The 7 things we have in here. This is our timeline, for example. Okay. Here we are saying, let's say 21 year. Copy this. No, I cannot copy this. Okay. Here we write again 2021. Here I write like this, 22. Number 4. All right. And 2021, this will be your year 0. Okay. This is your year 0. Year 1, year 2, year 3, year 4, year 5, year 6. Okay, look at here, 0, 1, 2, 3, 4, 5, 6. And here, the first year, let's say, your money is going out of 100,000. 100,000 is very common. We say $50,000 a year going out in first year. Okay. Then every year, money start to come in. For example, let's say this year is coming 10,000. First year. They're just examples, okay? They're just examples. Don't take it serious. 12,000. They're too big. Can I make it smaller? Too big. Yeah, it's better now. Otherwise you get confused which one is what. Okay. And let's say 800. Here, let's say 1,500. Okay. Here, let's say 900. Okay. Last here, let's say here is coming. Okay. See now, so this is your, let's say, outcome. Okay, the first year is minus, other years look positive, money is coming in. Let me take a snapshot. Oh, no. Snapshot of this one. Then I don't have to draw this again and again. All right, and let me keep this. Okay, let it be in here. Okay, let it be in here. That's perfect. Okay, and This is our line, for example, okay? So now, when you say non-conventional terms will be like this. Look, just on the first one, the first year the money is going out, all the time money is coming in. It's conventional. Non-conventional, it might happen that again in 2023, we have to again some money have to be invested. Some money will be going out of the business again. Okay, you have to think from business point of view. Okay, you have to think from business point of view. Are you making an investment? First year, look, $5,000 your investment you made. 2023, maybe you have to make another $2,000 more investment for some reasons. That is non-conventional. More than once your money is going out. Okay, that's what they mean by one or more net cash flows after the initial net cash out. That will be non-conventional. Hope it's clear. In our project, we will discuss only the conventional one. Okay. Now, another one is that another way we discuss is relevant net cash flows from a project subsequent to initial investment may take the form of either an annuity or a mixed stream. Annuity or a mixed stream. So how do they mean? They mean here this way. Annuity mean, if you talk about ordinary annuity, which means that like annuity comes two ways, right? The ordinary annuity, we make the payment at the beginning, right? So these things we'll be talking in here too. So here the mixed term stream is applied to any series of cash flow that does not represent an annuity. If it is, so annuity means that regular interval, the same amount of money coming into the business. That's annuity. Okay. If it is not same amount of money, that's not annuity. Mixed stream. Any other format, mixed stream. Not annuity, mixed stream. Consider that. Another one is this here. That investment projects can either represent an expansion of the firm's activities or a replacement of existing asset. When you make an investment, so the investment project can either represent an expansion of firm's activities or replacement of existing asset. So when you make an investment project, you might be making an investment because expanding the business. You're opening a new branch or opening a new segment of business or a new department or something, expanding a business. Or you have an asset in the business, you replace it. That's a big machine. You have to replace the new machine. So you have to know whether how much I have to spend on this machine or how much money I will get out of this machine slowly. Another. So now what these things you're talking about? You're talking about different investment project. Okay. One is based on the cash flow pattern. One is based on your money stream. The cash flow is coming, but the stream pattern, what type of how the money is coming in. Annuity style, mixed style, which style. Another one is here you're talking about, is it for expansion of the business or it is for investing in an asset or replacing an asset. Last one is how many projects you're handling. A group of possible investment. Who is that? Harry do. I think you forgot. Last week was our mid-semester break. Okay, please check on the unit outline, it mentioned there. Learning guide mentioned there. All right, next. A group of possible investment project. Can we actually not text and better we talk in the class? Because when you talk, I can give you answer very quickly. Texting, I need to. It actually disturbs me.
No voltage.
Can you please talk in the class, please?
Prepare.
It will help me also that I will feel like I'm alone talking in the class. It's not a monologue class, okay? I prefer students also make some contributions in our discussions. Okay, instead of typing those messages, talk to me. I understand we are getting habituated with texting thing on everything, but it's better if you talk to me in the classroom. All right, going back. A group of possible investment projects may either be independent or mutually exclusive. When you go mutually exclusive, it means, let's say you have two options you have. Two, project A, project B. Okay, you have project A and project B, two options. If you go for project A, you cannot go for project B. Or if you go for project B, you cannot go for project A. Any one you have to go for. This is mutually exclusive. Okay. Independent project means you have project 1, project A, project B, right? You can go anyone. If you go project A, doesn't matter, nothing to do with project B. You can go project B too, no problem at all. It depends on your capacity, abilities. Okay. So why we have mutually exclusive sometimes? Because of money problem, because of investment problem, because of resources problem. A lot of reasons could be there. That's it. So these are our different types of investment categories. Okay. All right. Determining a project's relevant cash flows. How do you determine the relevant cash flows? Like this says here, the relevant cash flows for a project are the incremental after-tax cash flows attributable to the project. These are generally divided into initial investment. I already showed you the initial investment. How does it mean by this? This one, that's 5,000 initial investment. Okay. Then annual operating net cash flow during the life of the project. This is important. So every year, how much money is coming in, annual cash flow, you see. Another one is called terminal cash flow. Terminal means last year's amount of money you're getting. Terminal means last year, termination. When terminating the project, the last year, how much money you're getting, that's the terminal. Okay, in one go, lump sum amount you receive, that's terminal. All right. If there is terminal cash flow, if there is any, yeah. When we talk after tax, we mean the company tax, okay? All right. So we say here, in general, we have relevant project incremental after cash flow for year or time t will be equal to after tax cash flow for firm with project undertaken minus after tax cash flow for firm without undertaking the project. With the difference between these two, will tell you relevant project incremental after tax cash flow for a year. Specific year, what we say here, relevant project incremental after tax cash flow. Whether it's increasing or not, how do you calculate it? It's said after tax cash flow for firm with project undertaken minus after tax cash flow for firm without undertaking the project. So if you take the project, how much after tax cash flow coming in? We do not take the project, how much cash coming? How much after tax coming? The difference between these two will tell you if whether the project is incrementing your cash flow or not. Okay. For capital budgeting purposes, the relevant cash flow do not include interest expense or other cost financing, as we are only interested in cash flow generated by the assets involved in the project. So we do not talk about here the financial cost. We talk only just about project. The project is giving me the cash or not, how much cash inflow, how much cash out. That's only we talk about. Moreover, financing costs are generally included in the determination of the cost of capital. Now, so we have here an example. Suppose we have the following comparison of cash inflows for some year in the life of a project. Okay, I think we all understand that in the any item in the bracket means negative. Okay. So if you have a project implemented, project not implemented, you take in a project and you do not take it. What will be our increment? We say here this. If you take the project, this is the situation you have. Okay, sales will be 1,200, 12,000. Not take the project, your sales will be 9,000. Cash operating cost, if you take the project, 5,000. If you do not take it, it will be 4,000. Depreciation, if you take the project, 2,000. If you do not take the project, 1,000. Pre-tax income is 5,000. Okay. Yeah, if you do not take it, it is 4,000. How did you get this pre-tax? 12,000 minus 5 minus 2, 9,000 minus 5 minus 2. Get this. Okay. All right. And here, tax is 30% tax. Okay. 1,500. 1,200. Net operating income 3,500. This is an example they showed you here, that if you have project implemented and project not implemented. Okay.
Sir, can you please, I think someone forgot to mute their cameras and it's just annoying. Can they just
Yes.
mute?
Yes. So who is that someone? We need to find out.
I think someone's in the
Anton
phone.
is talking to me, right?
Yeah, I'm talking to you.
Yes. And who else? Oh, everybody muted now. Okay, I think somebody here.
Okay, beautiful. Thanks.
That's okay. Let's move on. Okay, so note cash flow, the formula is in here. Cash flow will be equal to net operating income plus depreciation. That's how you calculate the cash flow. Okay. No interest rate is included in the calculation of pre-tax income. Okay, so cash flow, how are you going to calculate the cash flow? Cash flow will be calculated net operating income plus depreciation. So this net cash flow will be calculated as net operating income 3,500 plus depreciation. All right. So this is one example. We showed you that how to calculate the increment, the relevant increment, like here we said, relevant project incremental after tax cash flow for year or 20. This is the way you calculate these things. Okay. Cool. Now, next example we're going to talk in here, a detailed example involving a replacement project. Okay, we're going to talk about this one now. Let's do this one. Suppose an earth moving company is considering replacing an existing bulldozer with a new machine. See, big machine, bulldozer. Replacing an existing bulldozer with a new machine that will enable the farm to do more jobs. Following information is given. The new machine would have an expected working life of 4 years, and the existing machine is also expected to remain usable for another 4 years. Okay. If you buy the machine you have right now, the old machine, this can still go for another 4 years. That's okay, we understand. But if you buy a new machine will also last for another 4 years. Okay, good point. So timeline is same. The company pays a tax rate of 40%. Because this is different book, different countries book. That's why the tax rate is different. Australia is 30% tax. We know this one. Okay. And uses the private straight line method to depreciate both the new and old bulldozer. All right. The cost of new bulldozer is 50,000 and there are no installation cost. Depreciation of the old bulldozer is 5,000 per annum. Depreciation of old bulldozer is 5,000 per annum and it will be fully depreciated in 2 years' time. The salvage value of the bulldozers is 4 years' time is 5,000 for the new machine, 2,000 for the old one. Old machine can be sold now for if you sell the old machine right now, you get $8,000. The use of the new bulldozer will require an increase in net working capital of 3,000. To make the new machine work, you have some other costing involved. Now, if the old bulldozer is kept, annual profit before depreciation and taxes will be 30,000, while with the replacement bulldozer, annual profit before depreciation will tax will be 45,000. The following table summarizes the calculation of the incremental cash flows for capital budgeting purposes. So here is our example. Okay, 4 years, 0, 1, 2, 3, 4. Okay, determining the initial investment is here. Figures are in thousands. Okay, let's see 50,000 percent here. So these things they have in here. Okay, now. In this case, we'll be talking about, I'll show you here. So in this case, we're going to talk about, look at this. First it says, determining the initial investment. How much initial investment we have? Minus $42.2 thousand. Our initial investment will be how much? $42.2 thousand. How did you get this figure? Cost of new machine 50,000. There is no other installation cost. And when you go for new machine, you do not need the old machine. So you're going to sell old machine. Old machine will give you $8,000 because they said old machine has a value of $8,000 you can receive. Okay. Then tax savings on sale of old machine will be 0.8. Okay. All right. How did you calculate the tax saving? Okay. So you will find these things like some of the calculation that you may not understand. How do you get 0.8? You have to look at this side. Okay. Tax savings. Look here, we have given the notes in here. Okay. The tax consequences of selling an asset at more or less than its book value must be taken into account when determining the initial investment and terminal cash flow. It's written in the textbook. The time zero tax savings in the sale of old asset is calculated as follows: 0 tax. Okay. So look at how did they calculate it. Current book value of the bulldozer is $10,000. Currently, the book value is $10,000. When they sell the price of old bulldozer, it will be $8,000. So you are actually having a loss of $2,000. Okay. So since your tax rate is 40%, so this, since you are having a loss, so you don't have to pay taxes on this 2,000. Okay. So 2,000 into 40% is $800 will be your tax savings. That needs to be considered. And since the new bulldozer will need another $3,000 to make it workable. Another 3,000 will cost you. So all together plus minus you get minus $44.2 thousand, $44,200 is your initial investment. Okay. Then what happens in here? With new asset, then with new bulldozer, they mean here. Okay. Profit before depreciation and taxes is 45 every year. It's 45 every year they mentioned. Depreciation is, you say, the straight line method. Okay. So it will be how much? $50,000 is the costing of the goods. 50,000 cost of new machine. So every year it will be depreciated by 12.5 in 4 years time. Gone. Net profit before taxes, 45 minus 12.5, you get this figure. Net profit after taxes, it will be 19.5 every year. Net operating cash flow, how do you calculate it? Net profit after tax 19.5 plus depreciation 12.5. 32. Okay. With the old machine, if you do not sell it, old machine will be how much? Look at here. Profit before depreciation and taxes 30. It will be 30,000. Depreciation will be same as they said the book value of the machine is $10,000. We said here. Look, book value of the bulldozer is 10,000 is given there. Okay. And it will be depreciated in 2 years' time. So 5, 2 years' time, it will be completely gone. They mentioned it here. You notice it here. Right? Yeah, depreciation of the old bulldozer is 5,000 per annum. It will be fully depreciated in 2 years' time. Mentioned that here. So 5,000, 5,000, 2 years' time, 10,000 is gone. Net profit before taxes. So you get this figure. Net profit after tax. Subtracted net operating cash inflow. Net operating cash inflow will be, yeah, 15 plus depreciation, 15 plus 520, 15 plus 520, 18 plus 0, 18, 18 plus 0, 18. So incremental operating cash flow will be how much? 32 minus 20, 12. 32 minus 20, 12. 32 minus 18, 40. 32 minus 18, 40. So that's incremental cash flow for each year. Okay. Now, determining the terminal cash flows. The last year. Okay. What you doing in the last year? The last year, your new machine proceeds from sale of new machine. If you sell the new machine in last year, the salvage value will be $5,000. Mentioned there. Okay. Profit, how is that one? Okay. Yeah. The old machine can be sold now at 10,000. The use of new bulldozer will recurring increase. Okay. So where is that? The salvage value for the new machine. Yeah. The salvage value of the bulldozers in 4 years' time is 5,000 for the new machine. Okay, and 2,000 for the old machine. That's for this 2,000. Yeah. So here you go. The salvage value will be how much? 5,000. Tax on sale of new assets. We're going to tax savings will be tax will be minus 40%. So 5,000 into 40%, 2,000. Proceeds from sale of old assets, $2,000 you get from the old assets, plus tax on sale of old asset is 0.8. We calculated that already. And changes in not new net working capital is 3,000. The terminal net cash flow will be 4.8. Yeah, it's all plus and minus. Okay. So incremental net cash flow will be, it will all remain the same. So look, the first year you sell 44.2 is your initial investment. And if you go for the project, 12 will be incremental. Second year also incremental 12. Third year 14, fourth year 18.4. Now you have to add them all up and you have to see like this: minus 44.2 plus 12 plus 12 plus 14 plus 18. You have to see if it is more than minus 44 or not. That's what we need to find out. Okay. That's the whole project. That's the whole thing. All right. So how much initial payment and how much is your every year you cash increasing, you have to see. If it is more than minus 44, good, go for it. Now, this is an example we will use for our next capital budget methods. Yeah. We'll illustrate the basic capital budgeting techniques with a simple example. Two project A and B. Expected incremental net cash flow after tax. Project A is this, project B is this. So we will increase our cash flows. Okay. Now we're going to use the first method, is called net, the payback method we're going to use here first. Okay, payback method we're going to use here first. Year 0, initial investment, minus 70, and these are the cash flows coming in. The payback period is the expected number of years that will be required for the project to generate a sum of net cash inflows equal to the initial investment. So you have to tell us here how long it will take to get this minus 70. Get our 70,000 of initial investment. 20 and 30. 10 and 20, 30 plus 47. So in 3 years time for project A, 3 years time, we can get our money back. See? In 3 years time, we're going to get our money back. Project A. For project B, 30 plus 15, 45. Plus we need another 25. So third year, we're going to get actually 30. We don't need 30. We need less than that. So to find out, go for pro rata basis, we will go for it. So here, the project A is 3 years, and payback period of project B is 2 plus 25 by 30 is 2.56 years. How did they calculate 25 by 30? We need 25, but we are getting 30. We're going to do the pro rata basis. So 25 by 30. Okay, the whole year is going to give us 30,000. How long it will take to get 25? That's what to calculate. Okay. That's it for the payback method. Now, next one is about our net present value. Very important. Net present value. Okay. We'll talk about this one now. Oh. Okay. Oh. Okay. So this method is based on a consideration of discounted cash flows. This method is based on the discounted cash flows. Okay. The definition is in here. How do we mean by this definition? This says here, net present value is equal to, okay, cash flow or cash flow 1, and you can see cash flow 2, then you can see cash flow 3 dot 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 dot, it goes till cash flow 2. How do they mean? They mean here that you actually summation of all the cash flows, okay, minus the initial cash flow. Okay, minus the initial cash flow. Oh. All right. Okay. You see this? So that means that, so you actually, first of all, you calculate all the cash flows, you see all the cash flows, and you see the present value. So CF by this, you can see from here, you can see that the formula is actually, we're calculating the present values of all the cash flows. Okay, cash flow divided by this. 1 plus R to the power 1. Present value factor. Okay. Then what's happening? You're getting all the present value of your cash flows. After that, you subtract the initial investment minus CF0 cash flow, that CF0, that which has gone out. Like CF0 is this one, I'll show you here. I made it again. This minus 5,000 is CF0, cash flow of 0. minus cash flow because it's initial investment. CF1 is this one. CF2 is 1200. CF3 is 800. See that? So I have to bring up the present value of all these figures. How does it work? I'll show you. Let me see if I can do the predictions. Oh gosh, no, I can't. Yeah. I can try actually. Not with this, but with this drawing I can try. Show. Let's see if it works. I'll do this in shade. That's okay. That's what I use. These one. Oh, no. Anyway, I wanted to show this way actually. If that's the case, I can use actually annotations. Insert shows. All right, so I'll leave it here. I don't want to spend time on this one. So what in short, I will say this way, that all these figures that we have to bring them, the value of these items, value of these cash flows at 2020 at this specific current date. Okay, that's what I wanted to mean here. Okay. Then you have to calculate the value of this item on this day. Okay. It means that all the items value you will have to find out at this current date. Okay, that's what you have to find out. 1500 will not be the same 1500 as of today. Future value of 15, the present value of this future 1500 will be much more than that. That's what we try to say here. Okay. Let it be there. So that's what they mean here, the summation of all the items minus your initial investment. All right, so let's have an example they gave you here. Suppose that R is 0.110%, right? What are the net present value of project A and B above? The net present value of project A and B above. Where's the project? This is our project. We gave this project, project A and B. Okay. So yes, you can actually copy this project if you want to. Let me copy this project so you can understand it better. Okay. This is the project. So how much is your initial investment? Minus 70. That's your minus 70. According to the formula. Okay. First year is 10, 20, 40, 30, 10. 10, 20, 40, 30, 10. And here is your 1 plus R to the power 1, 1 plus R to the power 2, 3, 4, 5 years. For project B, 30, 15, 30, 10, 20, 30, 50, 30, 10, 20, and minus initial investment and this. This is your project A and B net present value. This will plug and play. It's nothing hard. Okay, that net present value. If your net present value is positive, you go for the project. If it is negative, you don't go for the project. If you see project A and B, A gives you better values, 12.37. B is 11.46. Okay. Now here, internal rate of return, IRR. Internal rate of return is the interest or discount rate that equates the present value of expected cash flows to the initial investment, which gives you net present value equal to 0. So this says that the same thing, what will be my R? What will be our R? That will make this figure as 0. What will be this R? That's the whole question. Okay. So the formula is this, thus R is such a this like N net present value will be equal to 0. If you go from this way. 1 plus R, this R is actually IRR to the power T minus CF. So what will be our IR? Okay. That's what they mean. So that's they say it's here. The summation of like after you did doing like N equal to 0. So this whole thing will become 0. So if you just change the side of CF to the other side, they get this figure. Initial investment will be equal to this. Okay. What will be our IRR figure? That's the whole question. So the IRR rule states that if IRR is greater than R, the relevant cost of capital at project is acceptable. Okay. If IR, internal rate of return, is greater than your R, interest rate, or discount rate, discounted rate, then project is acceptable. If internal rate of return is less than your discount rate, the project is not acceptable. Okay. So calculation of IRR is difficult using calculator, is not very easy, but possible. Okay. So they say in Excel, IRR of project can be calculated. So they use here Excel they're using. Okay. So consider a project A and consider project B. How did they calculate it? Look, They just assume that it will be 15%, for example, per annum. Okay. Suppose, example, consider project A, 0, 1, 2, 3, 50,000 is the initial investment, 20, 10, 40 is their outcome. So let's say, suppose that R is 15% per annum. What are the NPV for the project? What are the IRR for the project? So net present value can calculate very easily. Is actually net present value for the project is 1.25. Understand this thing? That's okay. Now we know the net present value equal to 0. For B, calculate the IRR. We know the net present value equal to 0. So we say that this is our formula coming up again. Now we are going this way. Please note, when R equal to 15, net present value equal to 1.25. We have already calculated this one. To get NPV equal to 0, R must be greater than 0.15. Now we are going increasing. So we are actually assuming. Okay. How do we do these things? We are assuming it will be greater than 15. So let's say 16. When you go for 16, it gets 0.2993. So I know that it's still not good enough. We have to do increase more. Let's say 17. Now we do 17. Now when you go 17, it goes actually minus level now. So it will be between 16 and 17. Now we do the trial and error method. Now it's now clear that IRR is equal to in between 16 and 17. Okay. How do you calculate it? Now we said changes in R will be equal to 0.1. All right, it is 16 and 17. Changes in net present values. Okay. So changes in net present values, this idea for 16 to 17, as you see. For 17, this 16 is this. Minus 0.92. This is a method we use. Our goal to find the value for R when NPV IRR is equal to 0. Okay. An increase in R of 0.1 result the change in value of this. So that's how they go for like they're going to pro rata basis in here. Okay. But if you use that IRR, so that's what they call 16.2 typical coming up to these figures like this. Because when it's 19 minus 9.230 IRR equal to 0.1, or equal to 1, it will be how much? It will be this, how much? So that's they're going for like unit method. Okay. All right, so that's the same thing for project B as well, I believe. Okay. I'm not going in depth, but we will do some exercise when this one comes up. So now, example 2.4. XYZ Limited is about to undertake a project and has computed the net present value of the project using several cost of capital as shown in project B. Cost of capital, if it is 10% net present value plus 30, 130, 50% net present value is plus 50, 20% net present value is minus 50. What is the approximate IRR of this project? So again, the same thing they're doing. IRR is half between 15 and, so you can see it should be 0, it should be 15 and in between 15 and 20, you can see that. Okay, minus and plus, minus 50 plus 50, that's again in the middle, 17.5%. A net present value profile can comparison with IRR method. So it actually just, let's go to project A and project B when they go through these things. Yes, okay, yeah. So you can see that at one stage it will come up that IRR and R equal to 0. That's what is your target to find out. Okay, that will be your IRR. So in here you can see at this point it will be 0. All right, I think I'll move on to the next one. Oh, As an example of this, suppose two mutually exclusive projects C and D. The last two mutually exclusive one, C and D, with initial investment of 20,000 and 145,000 respectively, and the single net cash inflow after 1 year is 28,000, 160,000 respectively. If the cost of capital at 12% per annum, each project would have a net present value of 5,000. And thus, a firm would be indifferent between the two projects by net present value criteria. In tabular format, we have these things. Initial investment, sold cash flow is net present value. And when R is 12%, discount rate is 12%. Okay. However, the project C has a greater safety margin in that the net cash flow at the end of 1 year could fall by up to approximately 28.6%, which is 8,000 by 28,000. All right, so how do they mean by this 8,000 by 28,000? 8,000 is coming from 28 minus 20, that's how they mean here. Okay, and the firm would still recover its investment. Okay. For project D, the net cash flow at the end of 1 year would fall up to 13.7%. Okay. The difference is, so 168 minus 145. So it is, because their sale can go, their cash flow can drop only 23,000, which is 0.13%. So how do they mean by these things actually? They mean this way. Look, with initial investment in 20,000 in project C, cash flow coming out at 28,000. Okay. So what percent of your cash flow can go down? If 28,000 is going down, 8,000 can go down maximum. If it goes, if more than 8,000 goes down, this is negative, this is loss. For project D, so it's out of 20,000, 8,000 can go down. It's okay. It's not that risky. But out of 168,000, okay, only 23,000 can be going down. So it's a bit risky. That's what they mean here. Okay. If the farmer is still to recover his investment, the IRR of project C and D are 40% and 15.6% respectively, which gives an indication related safety margin associated with the project. So we talk here about when you go for project A or B, which project you're gonna go. We'll check about which project gives us a safety zone, better safety margin than give us. Okay. That's the project we'll be going to. All right, I think I'll stop it in here. Now we'll talk about the last weeks, some of the questions from last week. Okay. All right, it's a lot of them. We may not go through all of these questions. Okay. And today, what we have discussed, we'll work some of these questions. So you'll go through the lectures, and I always, every week I upload these videos online. So you guys can actually go through these things online. On YouTube, you'll find the YouTube channel that I mentioned. You can find these things in there. All these lectures will upload. Then you will receive an email from Mohammed Reza. Okay. All exercises for the workshop. It is expected that the student will try the problems below at home before entering the workshop. The lecturer will help to solve this problem during the workshop. Okay. Note for the tutor. Okay. Please discuss some of the problems from this week in the next week, because next week there will be fewer problems. Okay. So we'll discuss some from this week, and the next week we'll discuss the rest. Okay. Let's see how far we can discuss it today. All right. So textbook question 6 to 25, page 294, basic bond valuation. Complex system has an outstanding issue of 1,000 par value bonds. Okay, they have 1,000 par value bonds with a 12% coupon interest rate. Okay, 12% coupon interest. They have a point of value. All right. Now, this says the issue pays interest annually and has 16 years remaining to its maturity date. Okay, and it has 16 years of maturity dates. All right. If the bond of similar risk are currently earning a 10% rate of return, how much should the complex system bond sell today? Describe the two possible reasons why similar risk bond are currently earning a return below the coupon interest rate on the complex system bond. This is our questions today. Okay. If the required return at 12% interest instead of 10%, what would be the current value of complex system bond? Contrast this finding with your finding in part A and discuss this. All right, let's solve this one. This says here, what is given? M is given. M is equal to 1,000. Okay. N is equal to 16. And M is equal to 1. Okay, coupon interest rate. Coupon interest rate is equal to 0.12. Okay, and the required rate of required return. Okay, which is your RD. To make these things in equation. Okay. Required return is RD. Which is equal to here 10%. Yeah, 10%. That's it. How much is your interest? Our interest is equal to 12% of $1,000. Which is equal to $120. Okay. All right. Now we have to calculate our bond value. Okay. Let's do it. What is our equation? I think I'll bring the equation from last week. I'm not going to type it down. It takes time.
خلصوا الأكلات؟
ايه يا حبيبي قلت لك
أحسنتي.
الساعة
لا خلص هلا على بكرة.
So this is the equation you're gonna use here. No. It's not working. I'll type it, it's okay. So here, bond 0 is equal to so here again. I divided by n. Okay. Then we're gonna enter the third bracket here. One minus one plus it's gonna be RD and to the power minus n into n. Below. Here plus here it will be n divided by this is the formula. Okay. You notice here we have the I. Okay. We have the I. We have m is equal to 1. Yeah. So if we copy this one here. And this one here is 120.
منصور بدك تكتب بطاطا خلي لي ربك شي 10 دقايق بس ودي لي مسج ريح مره
120 into 1 plus RD by M. So RD will be here. Let's say the RD is your 10%, 0.10. M is equal to 1, so I don't need to write down all these things. So we just write down here 0.10 straight to the power minus NM, M equal to 1, so N will be just 16. 16. RD by M, this will be here just 0.10. 0.10 straight, you can write it down. So here the M, initial investment that you have, 1,000. One plus RD by M. Okay. RD by M, you can write it down here as 0.10. Minus, it should be just 16. That should be good. That should be the rule. Okay. The answer of these things will be coming up as equal to $1156.27. Okay. So this is the rest. Numbers are given, all the figures are given. You can understand which figure is what. Okay, that's question number 8. All right. The B, describe the two possible reasons why similar risk bonds are currently earning a return below the coupon interest rate on the complex system bond. Okay. Two possible reasons. Look, after the issue depends on the demand and supply. It depends on the demand and supply of the money. It depends on the demand and supply of the money. That's the point here. Okay. All right. Interest rate will be high. So the demand for money is high. If interest rate will be low, if the demand for money is low, or the supply of money is high. Well, that's the case in this case in here. Okay. So, and another thing, so one is demand and supply, another one is the risk. Another two things. One is demand and supply of money, another one is risk. Two reasons will be included here. That's it. If the required rate at 12% instead of 10%, what would be the current value of complex system bond money? So let's say this, they want to say it's not 12%, it's actually now at 10%. What would be the answer? Okay. The same thing. It will be exactly the same thing we're going to do here. Okay, this is for question number C. B, I already mentioned you. Okay. It's not 10 anymore, it's 12. Okay. 12. No, that's it. Nothing else in there. All remain the same. Okay. The answer will be equal to 1. Okay. Answer will be 1,000. So now the saying that here, contrast the findings with the findings in part A and discuss what the difference is. Okay. So the interesting thing is this, look, this 1,000 is also your par value M. Remember? M, par value. When your coupon and the par is the same. Okay. When you will see that your required return and the coupon rate is the same thing, then your bond value is equal to your par value. Okay. Look here, there's 12% required rate of return. It's 12%. Now it's 10%. If it is 12%, when your coupon rate and required rate is same, it means that the par value and the face value will be the same. That's what it is.
So where did you get that equation from?
Sorry?
Where did you get that equation from?
Where did I get this equation from?
Yeah.
The last week.
Okay.
Which is in here. This is the equation from last week. So this one is here, look at here. Bond valuation. Okay.
Yeah,
And
cheers.
this is the initial equation. Then we converted them into and simplified them in this way. This is the equation. No, I cannot type on this one, but this is the equation. Okay. From last week. Because our practice questions is from the last week. Okay. So like today we talked about a net present value, payback period, these things. We'll talk about these things in next week. Okay, we'll talk about these things in our next week. All right. Okay, so let's go move on to the next one. Marigold's broker shown had two bonds. Each has a maturity of 5 years, a par value of 1,000, and a yield to maturity of 12%. Bond A has a coupon interest rate of 6% paid annually. Bond B has a coupon interest rate of 14% paid annually. Okay. Calculate the selling price for each of the bonds. Assume that Mary will reinvest interest payment as they are paid at the end of each year. Okay. Okay. All right. So let's do this one first. Let's finish it off first. Again, we use the same formula from here. Formalizing here. In this case, we're gonna actually do this one. How much is our N here? Okay. But in this case, our M is not like before. This one is 1,000 is okay. Okay. But in this case, the rate is 12% actually. 12%. This is 12%. Oh, no. 12%. 12%. This is fine. How much is our N? Our N is actually 6% is 12%, and our N is actually 5 years, isn't it? 5 years time. So our N is actually 5. Okay. 5. Okay, and this is 1,000. How much is our interest? Interest is 6% paid annually, so we have to calculate our N here. I can actually write it down here. I should write it down. I here is. I should write it down. And is equal to 1,000. And is equal to 5. Okay. required rate of return, RD is equal to 12%, which is 0.12, 12%. Okay. Our coupon rate equal to 0.066%. Now we have to calculate our I. Okay. I is equal to 1,000 multiplied by 6%. Multiplied by 0.6. Okay. So now you know this thing that this is 60. That's it. And the answer should be actually 783.71. That's it. M is equal to 1. Did I mention that? I will mention that. Let me mention that. That's it. So all this data is given, just plug in. There is nothing serious in here. Okay, this is for bond A. Okay. Right down here. And so okay, for bond A. Now let's do it for bond B. For bond B. M is 1,000, N is 5. Okay. Coupon rate is 14%. Okay. RD is 14%. Okay. Yeah. And N is equal to 1 because interest rate is being paid annually. Okay. And the coupon rate is actually 14%. So it should be 13, so it should be 1. All right. So now let's do it. So this is 140. 140. RD is 12, that's okay. N is 5, that's fine. M is 5, that's fine. Okay. So the answer here should be coming up as 1072. Okay. That's the answer. Okay. So bond A has a coupon 6% annually, then B So it will be 14% return. And other everything remains the same. Okay. Assume that Mary will reinvest the interest payment as they are paid at the end of each year, and that her rate of return on investment is only 10%. For each bond, calculate the value of the principal payment plus the value of the marriage investment account at the end of 5 years. Okay. What questions we have in this? Okay. These things are not that bad. These things are okay. All right, we'll continue as much as we can for today. Okay. All right, so now let's go with the other one. Answer for question B. All right, so here we have to calculate the future values. Okay, so this says here. So this says here that at the end of which at her rate, the return of investment is only 10% for each bond calculated. After 5 years, you have to calculate the future values. We say here at the end of 5 years, okay, both bonds, okay, mature and will sell for par value of $1,000. Okay. Now, future value for bond A and bond B. The future value for bond A is equal to let me get this. We're gonna get this is an annuity formula. We're gonna get. Let me copy this formula from the previous lecture. Hmm. I'll write it down. I'll write that down. Should be equal to, here is our I. I multiplied by in this way. One plus I. Ten percent of each bond. Rate of return. So just R and rate. To the power n 1 divided by R. Plus go to the that's the case. That's a future for okay. In this case, we will do it for 1B. Okay. Please say this one. Equal to I is equal to first one is 60. I is 0, 0, 0. It's equal to 0, 0, 2, 5. And should be equal to, it should be 1 to the 6. That's it. And for 1B, it will remain exactly the same thing, just it will not be one this is the return 140 actually. Okay, others remain the same, so it will increase by let's say 10. well, I can do that. This will be the difference. Okay. All right, next one. Suppose a particular corporate bond, okay, suppose that a particular corporate bond has a par value of 1,000 and the coupon rate of 8% per annum, semi-annual interest payment, and 10 years to maturity, and interest payment has just been made, and the current annual yield to maturity is 9%. What is the current market price of this bond? What is the current effective annual yield to maturity of the bond? So that's the one we do now. I have to copy this formulas. Okay. This is the case in here, but we have to change these figures. Okay. The M here is 100,000. Coupon rate is 8%. Semi-annual is M equal to 2 here. Okay. And 10 years, M equal to 10. Okay. What else? RD is 0, not 12, which is 0.09, 9%. Okay. How much will be our I then? So I will be in this I will be here 8% of 100,000, which will be 8,000. That's it. These are the data we have. Now this is the formula you're going to apply again. In this case now, it's not going to be 60 anymore. Okay, it will get you 8,000 now. $8,000 divided by M is 2. Okay, it's not 5 anymore. It's gonna be 5 multiplied by 2. It's not 12. It will be 0. It is not 12. R is 0.09. Okay. 0.09. It's not 5. It's actually 5 by 2. And this is not and 1 by n is done, I by n, 1 minus 1 by I by upper. This one needs to be actually 2. Okay. And n is 100,000. Okay. That's the way you calculate these things. All right. All right, so the answer should be coming up here. Yes. 92496. Okay. Now the next point comes up is about what is the current effective annual yield to maturity of the bond. Okay. Effective annual YTM we have to calculate here. Effective annual YTM will be equal to one plus right? 0.09 divided by 2 and here. Which will be equal to 0.092025. Okay, as you can say that approximately the figure is 9.2025%. That will be the answer. Okay. This one is here. So, okay, 7:27. I will stop it in here now. We have done till 3. We'll do the rest in next class. Okay.
Can I ask a question?
Sure. Let me stop the recording.
Okay.